Hello, and welcome to the podcast on credit scores. Can we get to that perfect 850? Is it possible? There's so much confusion, consumer confusion, just wrapped around the whole credit score issues and really kind of what plays into it and what do consumers need to do? How can they maximize their score? And those are just some of the things that we want to talk about today. Number one, some of the things that people always inquire about is why are there three different scores? And if there's three different scores, why do they wind up being different? Number one, why is a credit score important? We can talk a whole lot about that. What factors go into determining what your credit score is? And just kind of, is there any rhyme or reason at all to the models themselves? So if any of these questions are things that have crossed your mind, and probably most certainly they are, then this is going to answer a lot of those for you. So my name is Cheri, Landon, and I am the Community Development Director with the mortgage company. One of my roles is to bring some education to our community members surrounding topics like this that we get asked questions about all the time. The mortgage company has been locally owned and operated here for over 20 years, and we've been serving all the Coloradans in the area for that time. So we just want to bring some good education to them. I am joined today by Alexandra Erlich from Riverstone Law. She is an expert on credit reports and kind of how to interpret them. So we are going to go over a lot of these things today. So Alexandra, would you introduce yourself, please?
Absolutely. Thank you so much, Cheri, for having me. I can't begin to tell you how much it really means to me to be part of your community, part of the Colorado community, and making sure that we are bringing all of this education and clarification to light for everybody out there.
Great, thanks. So I think let's just start out. Number one, what I can say is a credit score, just being in the mortgage industry, a credit score is probably one of the most crucial pieces of a person's evaluation when they're applying for credit. So this is essentially, to keep it real simple, a credit score is an indication of what the person's ability is going to be to repay that loan, whether it be, in our case, mortgages or auto, whatever the case may be, what the ability is for them to pay back on the terms that are set forth and in a timely manner. And that really is going to be the number one determination in deciding whether someone should be lent funds to. That being said, why do we have three scores and why are they different?
So the reason that we have three scores in the mortgage world and in a lot of other industries, we actually don't utilize three scores. However, in the mortgage realm, the reason that we have three scores is because of the different models and algorithms that exist, which are computerized mechanisms that apply a mathematic formula utilizing a lowest integer, a highest integer, and different data points to ascertain an actual numeric value. Just to kind of break that down the short way, is to take everything that's going on in your credit profile and give it a number. And the reason we're taking that middle score and we have three is because different creditors choose to report either to one, two, or all three of the different bureaus. And the weighting on those bureaus is going to factor just a little bit differently based on what information's provided to them.
So not all places report to all the bureaus.
Correct, because there is a cost to them as a creditor to actually provide that information, to continue to provide that information on whether that be a monthly or a quarterly or annual basis to those bureaus.
Okay, that makes sense. I guess that's one thing that I and people probably have not realized is that would maybe determine why the scores are different depending on who's reporting.
Absolutely. And not just that, it even goes so much further in depth onto the creditors that we pay on a day-to-day basis that choose not to report at all, whether that be your landlord for a rental standpoint or your utility bills, cable, things like that, cell phone providers, auto insurance. All of them actually choose not to report on a regular basis to pass along the savings to the consumer.
Okay. Well, we'll get into a little bit more of that in detail as we go along. So I guess in determining that credit score, I know there's a lot of different factors that play into that. So how many actual factors are there that go into the credit score, and what are they?
So there's a total of 6 actual factors that are really relevant and prevalent in any scoring model. And each one of them has a slightly different weighting. And what we can do is really delve into each one of those one at a time if you'd like.
Yeah, that'd be great. So what I do know is payment history. Payment history, from my understanding, is the one that has the largest impact and the largest percentage of effects on a credit score. Is that correct?
It is. It's 35% of your entire score. 35% of your entire score is your payment history. Everything you've ever done right, everything you've ever done wrong, the way that you've actually been able to show your credit worthiness by your traditional history of repayment.
So you were mentioning too before that some things are reported and some things are not. What are some examples of some things that would not be reported, and how does that, I guess, what things are not reported, and what should we want to be concerned about paying all of our expenses, but as far as showing up on our credit?
Absolutely. So traditionally speaking, the things that you're not going to see on a regular basis are going to be your insurance, your utilities, your cable, rental agreements, any type of repayment of a personal debt to friends, family members, things along those lines. And what will be reported would be a mortgage, a bank loan, a auto loan, credit card of any type, and lines of credit, as well as negative and resulting accounts such as collections or charge-offs. So when we think about our budget on a monthly basis, and there's every family has that one difficult month. For my family personally, it's June every year between kiddos' birthdays, end of school, beginning of summer. There's that short month that every family has. In that month, if you have to make a choice of which bill to pay or not pay, I always recommend paying the bills that are reporting on the credit report first and then worrying about those other obligations. And if you need to be a little bit behind on those, don't be as stressed out.
All right. Well, good. That's good to know. Thanks for that. I know that another and probably the second largest piece is the balance versus the limits on any particular, like let's take a credit card, for example. A lot of people will say, if I have a $5,000 limit on my credit card, what is the smartest type of balance to keep?
Mm-hmm. Absolutely. When we're talking about balances versus limits, the first thing that we have to keep in mind is how the computer is interpreting this data. There's always the underlying piece of the fact that this is a computerized scoring mechanism. So when the computer is interpreting this data, it's not looking at rhyme and reason. What it's looking at in this particular category is anything that is coded as revolving. What that is going to be your equity lines of credit, personal lines of credit, and any type of credit card. You may have heard in the past that having a Visa, MasterCard, Discover, something with that primary logo holds more weight than having, say, a department store card. That's absolutely not true. Having any type of a revolving account is crucial to making sure that you're optimizing your credit score. For that ideal 850 that we're shooting for, we want to see at least one revolving account. I always personally recommend having 5, and they all carry equal weight when we talk about that balance versus that limit ratio. Ideally, we want to be under the 30% mark. So if I have a $1,000 credit limit, I want to keep that balance under the $300 mark at any point in time. And that's also most relevant when I'm about to go into any type of a financial transaction, be it a mortgage or a auto loan purchase. That's when it's most important that I keep those balances as low as possible.
Okay, so if I'm understanding that, it doesn't necessarily make a difference what the balances are on if we have 3 different cards or 4 different cards, what the limits are necessarily. It's the ratios of how much you have charged, and just because one might have a higher credit limit, that's not going to have more of an impact. You said they were all equally weighted.
Correct. It doesn't matter if one is your home equity line of credit at $100,000. If that's maxed out, you've already reduced your credit score by whatever the value of that account is. For example, if you only have one revolving account, whatever your balance versus your limit is on that particular account any given month counts for 30% of your entire score. Wow. If it's fully maxed out, you've minimized your score by 30%. The very next month, you go ahead and hit Powerball, you pay that thing off, and you've actually gained that same 30% right back. You're seeing that fluctuation very, very quickly, and that's the easiest way to impact our score.
Is to pay down our bills.
Absolutely.
Okay, and on that, so how often should someone be using those cards to keep them, let's say, in an active status?
I really recommend at least once a quarter every single card for a pair of socks. A pair of socks is just a nice, easy number that we can all wrap our heads around and not necessarily go too far overboard.
Okay. All right. Well, that's good to know too. So let's say, for instance, I'm new in the world of establishing credit and I've kind of, messed some things up in my history and I'm trying to establish some credit and I can't get a card. Are there some other things that I can do?
Absolutely. First off and foremost is that there are a number of credit card companies out there that will provide credit as long as you have not had a derogatory account history with them in particular. One of those ones is Fingerhut. I know a lot of us still remember Fingerhut as that catalog that our great-great-grandmother had sitting on the coffee table. They happen to still be in business and will give almost anyone a line of credit. Definitely one of my first choice options on somebody looking to build. Another option is what's called a secured card. We want to be really cautious with a secured card and not confuse it with a prepaid card. A prepaid card being something you can pick up at Walgreens, at Target, at the grocery store, and then you can just load your cash onto to have a little bit more security than carrying around all that green. On the flip side, a secured card still requires application, is written by a bank, takes the money that you deposit into an account and uses that to collateralize the actual credit card that you're then able to utilize.
Okay, great. So there are some things that we can do out there. All right, so the next piece is age of accounts. So how does the age of the account factor into your overall credit score and how important is that?
So that is weighted at 15% of your entire score. And the reason that it's so important to make sure that we're letting our accounts age out and have that long length of history is to show the track record, show our ability to consistently use, repay, use, and repay again. What the computer, again, is looking for to really maximize this entire 15% is a 25-year length of history. Now, that 25-year length of history isn't just the length, it's the average of all your open accounts. That's where, as you were asking before about making sure things don't go inactive, we really want to make sure that we're using those cards consistently and looking at what the big picture is if we're ever considering closing an account out.
Okay, so, and that's actually what I was going to ask you next. So a lot of people often say, should I close this account? And I guess the answer isn't really that simple, is it?
No, it never is, because it really depends on where else that card or account is being weighted within the overall picture of their scoring model, whether that be their oldest account with their best payment history and their lowest balance. I always recommend that a client look at the big picture and get advice either from a mortgage lender or a credit professional before closing out that account. Also, in looking at that account, figure out why they want to close it in the first place. Is it simply because they just don't use it and it's collecting dust? Okay, maybe it's not so atrocious to use it every now and again just to keep that activity. Or is it that it has an annual fee, monthly fees, things that are actually prohibiting the rest of someone's budget overall?
So I guess it's not necessarily a good idea just because you get mad at the customer service rep to just go ahead and close that card, because you could be hurting yourself really more than you would realize.
Exactly. It's kind of like marriage. We can't necessarily get divorced every single time we get upset.
Right. Exactly. Don't leave your cards. Another question that comes up often, and I guess in relation to age of accounts. Can you just briefly talk about student loans in that? And again, going back to a lot of these people who are just new, trying to establish some credit and really don't understand maybe what some of the advantages of those student loans could be in this respect.
Yeah, the really cool thing about student loans is it's a great way to inherit and grandfather in a longstanding credit history. The minute that student loan comes out of deferment, keep in mind we're looking at how's the computer interpreting the data that it's being presented. It's not necessarily rhyme and reason and logic. It's the computer is programmed a specific way. When we look at that, the computer sees that a student loan has been in deferment for, on average right now, I believe nationally, it's at 9 years. Can you believe that?
Wow, yes.
I mean, golly. Yeah. So the minute that kiddo makes the very first payment on that 9-year-old deferred student loan, the computer thinks that same loan has had 9 years of perfect payments.
Ah.
So it's now impacting that 35% of payment history. It doesn't count in the balance versus limit. A lot of people get caught up that, oh my gosh, my student loan balance is now actually higher than what I originally borrowed. I'm completely getting dinged on that. That's not true because it's not considered a revolving account. So it doesn't impact that 30% whatsoever. And then on the length of history, it's counting for that 9, 10, 11, 12-year-old account, and there's usually multiple student loans. There's usually a different student loan number for both a subsidized and unsubsidized portion each and every semester. A kiddo graduating college could have as many as 12 or more even student loans, all with anywhere from a 4 to 7 to 9 year history, that when you take those all individually, add them together and weight them out for an average, drastically lengthen that history.
Okay, so I think that's some really good information. There's a lot of people out there, not even necessarily, people that go back to school later in time. They've had loans for some time, and the big question is always, should I consolidate those? I think before people make those decisions, they really ought to know how it could impact their credit score, both in a positive or negative way. So that's good to know. Thank you.
My pleasure.
All right. So I know another big area is the types of accounts. So how many different types of accounts are out there that is accounted for in a credit score?
There's 4 types of accounts, one being mortgage, which is obviously a huge percentage of people not necessarily having as a type of account on their credit these days. They're trying to go into the homeownership process and have not actually had a mortgage in the past. The second type is an installment loan, which could be your student loan debt, an auto loan, things like that you're paying on a monthly basis and that have a full amortization are going to fall into that installment loan category. Revolving is going to be that credit card debt. And the final category is other. This is another one of those counterintuitive pieces to the credit scoring model, because other a lot of the times is going to be a medical collection or a utility collection. And we don't want those things on our credit, yet they can potentially help us in a small way, depending on the big picture, by giving us something in that other category.
So on the different types of accounts, so there's 4 different types, are they, for that portion of the credit score, are they treated equally or not?
They are. Each one counts for 2.5% of your entire score potential. And what we want to really think about when we're looking at credit as a big picture is that credit's not like school. We don't all start with an A and work our way down. Oh, geez, something happened in life. Now I'm an A-. That's okay. I'm still better than average. A slightly different shift on that perspective is looking at our credit as we would a sporting activity, of the score being a multiplier of the actual execution and the degree of difficulty being applied to it. So that 35% we talked about in regards to payment history and how well did I make those payments in a timely fashion, and have I always been consistent? That's going to be your execution. The other 65% is actually going to be the degree of difficulty. What is my potential? That being said, your potential to truly gain that 850 maximized score from that computerized model is going to require something in all 4 of those categories. It's not to say that you really need to go open new accounts either to have something in each of those categories from a lending perspective or day-to-day credit usage.
Right. Okay. All right. So I think that this next is the most asked about, and that is inquiries. People are always saying, what does it mean and why would something make an inquiry on my credit? And I know there's two different types that I'd like you to kind of just tell us what the difference is. So there's a soft inquiry and a hard inquiry. What's the difference?
And another way of phrasing that, just in case anybody has heard the different terminology, is a hard pull versus a soft pull.
Right.
Some people do know the terminology inquiry. It's also referred to in the industry as a pull.
Pulling your credit, exactly.
Yes. And a hard inquiry would be a request for money. And a soft inquiry is a request for only information. Some applied principles of that. When you get that pre-approved offer in the mail from the credit card company, they've done a soft pull to see where you stand and see your credit worthiness overall. And then when you call and accept the offer, now you're requesting money, it transitions into a hard pull. Every single hard pull is going to count in the 10% category of inquiries and is going to account for anywhere from 1 to 5 points. That's going to count for about an 18-month period in time. In addition to that, though, those soft pulls, when you're doing it as a consumer online, when you're going in and looking at your credit card statement, things along those lines, those do not count against your credit score because they are not factored.
Okay. And so on those soft pulls, because you mentioned, I think everyone has gotten the you've been approved and just give us a call. And so they've done a soft pull. Does someone in that instance need permission to do so?
No, they do not. And on the soft pull, because it's simply a request for information, it can be requested frequently. Another place that we see those soft pulls happening on a very consistent basis is actually your auto insurance and homeowners insurance. Those insurance companies, every time that they're looking at renewing your policy, will go ahead and do a soft pull to see if anything's drastically changed.
Interesting. All right. And so another thing often heard. So in other words, there are times you have to have a hard pull, like you said. If you are applying and looking for actual dollars, such as in a mortgage transaction or purchasing an automobile, they need to do the hard pull. So if someone goes and is shopping for a car, let's say, and the car dealership is going to say to you, oh, it doesn't matter how many dealerships you go to and how many times you get your credit pulled. None of this matters. Is there any truth to that?
There is. And we have to factor that that's only true in the auto world. Because there's these different scoring models, these different scoring algorithms, the ones that are utilized in the auto world are not the one and the same for the mortgage world. And the one in the auto world says that all inquiries within a 30-day window all count as one as long as they're used for the purpose of shopping for an auto loan. On the flip side, in the mortgage world, each and every one of those inquiries is going to count for 1 to 5 points. And what I always like to look at this as is what is the end goal? Are we shopping for a mortgage because we really are that concerned over $100 or $200 in fees, and so therefore we need to go shop around? Or are we shopping because we're looking for that best fit as a lender and from a personality and product standpoint? If we're perfectly happy with the product, the service, everything that we're being offered, there really isn't the need to go shop that around and worry about those inquiries.
Right. Okay. So there's so much that goes into this. And I think that, I guess if I could ask you one thing from a consumer standpoint, is there any, they have so many services out there that you can monitor your credit, or, you get your free credit reports. Is there any that you would recommend and for consumers just to, from awareness standpoint?
I like to look at it as that no data is ever bad data. No learning or question is ever a bad question. And it's what we do with that information that counts. When you're monitoring your credit on a daily basis, taking time and energy out of living the life that you want to worry about a point or two without necessarily an end objective in mind, I don't find that meets any objective. Just to kind of simplify that is, looking at your report once a year, getting your free credit report, not online, but getting the annual report that you can request by phone or mail from each of the 3 bureaus, just to ensure that everything on there looks correct. Doing once a year a report from a mortgage lender or your local bank so that you can again see that everything's looking on point and nothing has been opened in your name. Absolutely, I recommend that. Monitoring it from a score perspective and on a frequent basis, I don't find the need for.
Right, because it really is a moving number, even depending on, where you are in your statement cycles, for instance, right?
Absolutely. And not just even where you're at in your cycles and the statements, but it's also what's going on within your world that piece of the year, whether that be that big month that I was mentioning before in my family coming down to birthdays and family vacations, or whether that be the holidays.
Right.
A lot of people have those constraints different times of the year. And when we talk about people that are self-employed and they have different cycles within their business and needing to utilize different pieces of credit, there's always a time and a place for living life.
Right.
And that's where I kind of say back to you from a mortgage perspective, what on the mortgage end do we really need to have that 854? Is there really any product difference going all the way up to that 850?
No, there's not. There's more differentiators on the low end as far as, what types of products you can qualify for. But I will say from a mortgage transaction, let's just even just talk about purchasing a home. When you're purchasing a home, there's a lot that goes into that transaction from, the inspection to the appraisal to the contracts, and the lending piece being the biggest. So then in the lending piece of it, the number one thing that needs to be evaluated is the credit report. So I think that if anyone is looking to venture and purchase a home, the first thing that they need to do is go through the process. And one of the first things, when someone makes application for a mortgage, the first thing that we do is pull credit, because we have to evaluate that credit. And unfortunately, oftentimes there's errors on a credit report, things, that need to be dealt with and or planned for. Whether, and actually, I'm going to have you speak to that a little bit, but, in the event that creditors have not removed items from your credit report when they were supposed to do so, what do you do in those instances? Sometimes you're not, for credit reasons, going to be approved necessarily up front because there's things that need to be dealt with. So if someone does need to deal with that, I'm guessing you offer some of those services as well.
Absolutely. And I know that one of the other big pieces that from a lending perspective, you always advise people is not to open new credit.
Correct.
That's actually that final category that when you were asking what goes into that credit scoring model is new credit. So one of the factors that's been programmed into the computerized model is to say that until you've made 6 payments, not 6 numeric calendar months have gone by, but 6 payments have actually posted to any new account, it's going to go ahead and suppress the score by sometimes as much as 10%. And the reason for that is not just because of that inquiry, not just because of that shortening of the age of accounts, but also because the computer has been programmed to understand that this new account could throw everything else out of balance or could make everything else perform better. After you've made those 6 calendar payments, 6 actual payments through, and those have been posted, then the computer has already been factored to say, okay, now we have a track record, what is considered a viable track record, to decide whether this account's going to turn anything else around.
So that's back to the payment history, which is so critical. Payment history in general, whether, I don't care what kind of debt it is, that's absolutely, when I say to people, when they're talking about credit scores and why is it so important, I say if it were flipped around, Alex, and I say to you, hey, do you have $200,000 I can borrow? And you look at my credit score and it's 510. Yeah. You're most advantageously going to say, you know what? I really like you, Cheri, but it doesn't appear that your likelihood to pay me back is that great. So it's, you got to flip it and understand that that really is an indicator of someone's ability to repay. And that's why you need to do everything you can in your power to preserve that score and maintain that score for so many things in your life.
Absolutely. And just knowing what those factors are and being cognizant of them, not necessarily on a day-to-day basis, but whenever we're about to make those financial decisions and going into a major purchasing phase in our life, being able to plan accordingly ahead of time and having that 6-month, 12-month, 18-month, 24-month game plan to be able to plan accordingly on how do we pay those balances down? How do we look at making sure we're not opening or closing anything right now? That's always going to be a crucial piece.
Right. Absolutely. So if you would give your contact information as well, because if someone has more questions about their actual credit report, or if there's anyone out there that knows that they need to deal with some things on their report that isn't accurate, how could they get in touch with you?
Absolutely. So again, my name's Alexandra Erlich, and I'm with Riverstone Law. We are a local credit repair company here in the Colorado marketplace. I can be reached on my direct cell at 303-668-0300 or on my email at Alexandra, Alexandra, at riverstonelaw, riverstonelaw.com. I can also be reached on Facebook or on LinkedIn at any time.
Great. And for those, again, out there and having any consideration about purchasing, it really is advisable to at least just know how to start the mortgage process, have the credit pulled, and make sure we determine whether there's anything that we need to do. And our website is themortgageco.com. And this also will be available and accessible, and I can be reached as well, Cheri Landon, and my cell phone is 561-301-2055.
Thank you so much for everything, Cheri. I really appreciate the opportunity to share with the public so much information. And please know that there's more, and we can go in depth on this for days and hours. And
I know.
Obviously, we don't want to bore anyone. That being said, that if anybody has any questions or is looking to get into that buying phase and cycle, I can't stress any more loudly that talking to a mortgage professional, a credit professional, not trying to analyze it on their own is the key piece that's going to get them to that finish line so much more rapidly and with a happy, positive outcome.
Absolutely. And I really thank you for coming. It is a lot of information. It's overwhelming. There's many different pieces that goes into such a vital number for all of us to be paying attention to, and just making sure that we're out there and doing the best we can so we can be making our purchases when we're ready. So Thank you so much. I appreciate your time.
Have a wonderful day.
You too.